When markets are calm, it's easy to feel confident. Your portfolio is growing, the news isn't too alarming, and retirement feels like it's on track. But what happens when the headlines get ugly? The Dow drops 1,000 points. The S&P swings 5% in a week. Interest rates spike, and every news outlet is talking about the next recession. Suddenly, that sense of control starts to disappear. And if you're retired or getting close, the stakes feel even higher. Because now, it's not just about paper losses, it's about whether you can still retire, stay retired, and draw income without running out of money. I see this all the time. Volatility doesn't just test your portfolio, it tests your confidence. And the difference between panic and confidence, it comes down to having a plan. Hi, I'm David Hike, financial advisor at DMH Financial Solutions. I help retirees and pre-retirees build investment and income strategies in all types of market conditions. In today's video, I'm going to walk through 4 steps you can take to manage market volatility the right way, so that short-term uncertainty doesn't knock you off track in retirement. Let's get started. Step 1, understand what volatility actually means. Let's start by reframing a word that often creates stress and confusion for investors: volatility. We tend to associate volatility with something negative, something dangerous. But in reality, volatility doesn't mean loss. It doesn't mean your retirement plan is broken. And it doesn't mean your investments are failing. Volatility simply means that prices are moving more than usual. Sometimes up, sometimes down, sometimes both within the same week or even day. While it may feel unsettling, volatility is a normal and necessary part of the market cycle. It's the market reacting to uncertainty, which could come from economic data, inflation concerns, interest rate changes, corporate earnings, or geopolitical events. But here's the key takeaway. Volatility is temporary. Panic is permanent. Why this step matters? The reason I start here is because volatility is emotional. You open your statement and you see your portfolio down 10, 15, or 20% or more. And the instinct is to act, to move to cash, to do something. But most of the time, reacting emotionally to short-term market movement does more harm than good. Per Hartford Funds and Morningstar, the people who stay invested during market downturns are the ones who benefit most from the eventual recovery. On the other hand, the people who panic, sell low, and try to time their way back in, they often miss the bounce back and end up locking in real losses rather than riding through temporary dips. Let me give you a simple analogy. Volatility is like turbulence on a flight. It doesn't mean the plane is going down. It just means you're hitting some bumps on the way to your destination. A good flight plan includes turbulence. A good pilot doesn't overreact. And a good retirement plan, it should expect volatility and be built in to stay on course anyway. Do you know what you're actually exposed to? This is where it gets personal. If your stomach drops every time the market dips, it might be because you're taking more risk than you're comfortable with. And that's something we can plan for, because the goal isn't to eliminate volatility. That's not possible. The goal is to understand it, prepare for it, and build a portfolio that gives you the confidence to stay disciplined, even when the market is shaking a bit. So let me ask you, do you know how much risk you're actually taking? Because that leads directly into step 2, revisit your risk exposure. And that's where we start turning awareness into strategy. Step 2, revisit your risk exposure. Now that we understand what volatility really is, the next question is, how much of it are you exposed to? Because here's what I see all the time. People get uncomfortable during market swings, not because the market is doing something unusual, but because their portfolio isn't aligned with their risk tolerance or their stage of life. Risk is personal. Let's be clear, risk isn't good or bad. It's a tool. The real question is whether the level of risk you're taking today is appropriate for your age, income needs, and financial goals. When you're younger and building wealth, you can take on more market exposure. You've got time to recover, and you might be contributing regularly. But once you hit retirement, or even a few years before, you enter a very different phase. You're no longer adding to the portfolio, you're withdrawing from it. And that changes everything. The risk that matters most, sequence of returns. One of the biggest risks retirees face isn't the average return over 30 years. It's what the market does in the first 3 to 5 years after they start withdrawing. This is called sequence of returns risk, and it's critical to understand. If you experience poor market performance early in retirement while you're taking withdrawals, it can permanently damage your portfolio's long-term sustainability. Why? Because you're selling investments at a loss to generate income, and that loss becomes locked in. Your portfolio has less capital to recover when the market rebounds. Realignment creates resilience. This is why we revisit risk exposure. It's not about timing the market or eliminating volatility. It's about building a plan that gives you confidence in both good years and bad. That means asking, is your current asset allocation too aggressive for your stage in life? Do you have enough lower volatility assets to cover 1 to 2 years of income needs during a downturn? Is your withdrawal strategy flexible enough to adjust if needed? Risk tolerance versus risk capacity. Here's a subtle but important distinction. Risk tolerance is how much volatility you're emotionally comfortable with. Risk capacity is how much risk your plan can mathematically afford. Some retirees may have a high risk tolerance, but that doesn't always mean their portfolio has the capacity to absorb that risk once withdrawals begin. So we take both into account. What you can do right now, if you're unsure where you stand, here are 3 simple steps. 1. Review your current asset mix. Are you still invested like you were 10 years ago? Has it drifted too heavily towards equities? 2. Run a stress test. Model what happens to your portfolio if the market drops 20% this year. Could your income plan hold up without disruption? 3. Build a cash buffer. Do you have enough to cover living expenses for 12 to 24 months? That way, you wouldn't have to sell stocks in a downturn to meet cash flow needs. The goal isn't to avoid volatility altogether. It's to make sure that when volatility shows up, which it will, you're not forced into decisions that derail your retirement. And that's what we'll cover in step 3, using guardrails instead of guesswork, so you can adjust your plan, not abandon it. Step 3, zoom out. Don't let headlines make your decisions. Let's be honest, when the markets are swinging and the headlines are screaming, it's hard not to react. You hear things like, market panic, biggest drop since 2008. Investors rush to safety, and suddenly you're wondering if you should pull your money out. But here's the thing, the market and the media are not the same thing. The media's job is to get your attention. Your job is to stay focused on your long-term goals. So let's zoom out for a moment. Take a look at any 30-year chart of the S&P 500. You'll see dips, crashes, corrections, but what else do you see? Recovery, growth, compounding. Even the most severe downturns, tech bubble, 2008, COVID crash, eventually gave way to new highs. But the people who benefited from that recovery weren't the ones who jumped out when things got scary. They were the ones who had a plan and stuck with it. If your retirement plan only works when the market is calm, it's not a real plan. Your strategy has to be built to withstand noise, headlines, and short-term volatility. So what can you do? Avoid checking your portfolio every day. Turn off the financial news if it's adding stress, not clarity. Focus on your long-term goals, not this week's performance. Volatility is a part of investing, but reacting emotionally to short-term headlines is where the real risk lies. And that brings us to our final point, because volatility doesn't go away, so your strategy has to account for it, not just avoid it. Let's talk about that in step 4. Have a plan that includes volatility, not one that avoids it. Here's the truth no one likes to say out loud. You can't avoid market volatility. No one can time it perfectly. No one knows exactly when it'll start or stop. And no portfolio, no matter how well built, is completely immune. But that doesn't mean you're powerless. In fact, most resilient retirement plans don't try to eliminate volatility. They build around it. Let me walk you through what that looks like. First, your plan should include segmented time horizons. This means your money is broken down into buckets. Short-term money for the next 1 to 2 years, stable liquid assets. Mid-term money for 3 to 5 years, conservative growth assets. Long-term money for 6+ years, exposure to growth and equities. This approach helps you ride out market dips because the money you're drawing from today isn't the money you need to grow for the next 20 years. Second, have a withdrawal strategy that adapts. If the markets are down, can you reduce your withdrawals for a year or two? Can you pause cost of living increases? or skip a discretionary expense. This doesn't mean depriving yourself. It means giving your portfolio room to recover. And sometimes that makes all the difference over a 30-year retirement. Third, make sure your plan includes tax coordination. During volatile markets, strategies like tax loss harvesting or rebalancing can be powerful tools if they're built into your process. They might lower your tax bill while helping you stay invested and maintain your allocation. Finally, check in on your plan regularly, but not reactively. Markets change, your life changes, and your plan should evolve with you, but always from a place of strategy, not stress. Because here's the key takeaway. Planning for volatility is proactive. Reacting to it is emotional. And when you're in retirement, emotional decisions could be quite costly. So let's recap the 4 steps to managing extreme market volatility. 1. Understand what volatility actually is. Temporary movement, not permanent loss. 2. Revisit your risk exposure. Make sure your portfolio matches your time horizon and income needs. 3. Zoom out. Don't let headlines drive long-term decisions. 4. Build a plan that includes volatility, not one that breaks down when markets get rough. Here's the bottom line. Volatility is normal. It's uncomfortable, but is a part of the process. And the people who get through it with confidence aren't the ones who guess right. They're the ones who are prepared. If you're retired or approaching retirement, and you want to make sure your income plan is built to withstand the ups and downs, let's talk. Click the link in the description to book a consultation with me. We'll walk through your current portfolio, your income strategy, and your goals, so you can stop worrying about market swings and focus on what really matters. Thanks for watching, and I'll see you in the next video.